CTV18, thanks a lot for joining in and have a great 2023. Well, let's move on. HCL Tech is the stock of the moment. It delivered a beat on revenues and margins. Its constant currency growth rate of 5% sequentially is the highest amongst its peers. Rima caught up with the top management of HCL Tech, began by asking them about the quarter gone by. Let's listen in.
We have the product business, which is going to be seasonally a weak quarter, Q4. I mean, like this quarter, Q3, the product business had a fantastic growth. So some of that will moderate in Q4. So that's the primary reason you will see Q4 is a little softer in terms of the overall growth rate. Otherwise, we expect healthy growth in services, and it'll get a little bit offset by the decline in the product business in the last quarter.
Okay, but can you give us an indication on whether the furloughs that we saw in Q3 will extend into Q4? In retail, you had indicated a ramp down of certain clients. Is that something which will spill over into Q4? Some more nuance on individual sectors and geographies in Q4?
Sure. I think, furloughs was a little higher in the last quarter. In spite of that, we delivered very good numbers. A little bit of that will spill over, especially Asia-Pac, financial services. We see a little bit more furloughs in the JFM quarter, but that's all baked in. I think we've given a total guidance of 16 to 16.5 in the services business. All of that is baked in. And in terms of verticals, we've had some very strong bookings in the last quarter. Not only the O&D quarter, but even the July, August, September quarter, we had some excellent bookings, both in financial services and retail CPG segments, apart from broad-based kind of a growth. But the special call-out will be financial services. We've booked more than $1 billion kind of TCV in just large deals in financial services in the last couple of quarters. All of that will start flowing into the revenue numbers from Q4 onwards.
And the ramp down of the retail CPG client that you saw in Q3?
I think it's almost done. So, I mean, maybe you will find Q4 a little bit, but from next financial year, we see a strong uptick in the retail CPG segment. And that's also enabled by the new bookings, which is a couple of deals that we announced. We announced ODP, we announced Mattel, both are in the retail CPG segment. Both of them will give us good headwinds, good tailwinds in the Q1 of next year.
Prateek, wanted to get the margin outlook for next year, FY24. This year's margin guidance is known now, but in this quarter, you've almost touched 20%. Do you think in FY24, EBIT margins for HCL Tech could be in the range of 19 to 20%?
Rima, good morning, and thank you for the question. First of all, let me react to some of the questions you asked CVK in the last few minutes. I think, like I said, this is a quarter of 19s. Our revenue growth was 19.6%, and our net profit growth is 19%. I think we should just celebrate that because it is a seasonally good quarter for the products. But on that seasonally good quarter, we have delivered a 19.6% growth because the same seasonality was there last year, same quarter as well. And, 19% profit after tax growth year on year. So I would celebrate that. And seasonality is seasonality, right? I mean, at the end of the day, if the product revenue went up $100 million this quarter, some of it will come down, maybe not 100 million, 75 million, whatever it is. And that will have that, but on a year-on-year basis, again, that will be the right way to measure it. So I would just want to submit that for the viewers and all the investors and analysts, because that's just seasonality. We have to bake that in, that is baked into our guidance, and that's the right way to look at it. Coming back to your question about profits, we have indicated in our US Investor Day just last month as well that we are very focused on getting back to the comfort range of 19 to 20% EBIT at a company level. And that is what we are gearing towards. We got into that band thanks to the seasonality in the products business this quarter. And that is what we are aspiring towards. Whether we'll hit it in FY24 itself is something I'll hold the question for the next quarter. We'll come back and give you the guidance for FY24 the next quarter.
Prateek, while decision-making has slowed down, and this has been reiterated by all of you all, have we seen any deal cancellations? And is there a risk to your deal win momentum, which you're currently enjoying of $2.3, $2.4 billion?
So there is no deal cancellation for sure. Even, I don't think we said that there is a slowdown in deal making. Even after 9th December, when we came and gave you those additional bites, we said, deal wins continue to be decent. And that's what we announced yesterday. $2.35 billion is a very good number for us. And you're absolutely right. We have been in that narrow band of $2.5 billion every quarter on the trot for at least the last 5-6 quarters. So I would not say deals have slowed down. Yes, there are some. I mean, Europe is one geography we talked about, but at an overall level, we are not seeing a slowdown.
Okay, so Europe is the only geography which is challenged for you right now. CVK, do you think despite the macro and the uncertainty, FY24 could still see double-digit growth for you? Not getting you into numbers, but just wanted to get a direction from you and your thoughts on this.
So let me just add one small dimension to what Prateek said, since you talked about margins, right? I mean, margins were also very good last quarter, 19.6%. Now, while a lot of contribution has come from the product business, what we have to acknowledge is there is a 70 basis points improvement in the operating parameters. So it's been an exceptional quarter of execution where we delivered efficiency in the operating model, whether it is freshers, automation, and better utilization, all of that. So I think that's really talking about the key levers that we have for improving margins, whether it is freshers, whether it is improving utilization, improving realization. All those metrics are a very, very sharp focus for us. And that was the logic of providing a roadmap of getting to 19 to 20% margin profile. Now, coming to FY24, I think at this point, we can only talk of certain leading indicators. If you look at even at the lower end of our guidance, I think we will have at least 2.5%, 2.5 to 3% kind of exit tailwind that will come. And on top of that, there has been some significant deals that we've announced. A lot of that will really deliver revenues in FY24. The one that we announced last quarter, the $1 billion very large deals that we won in this quarter, all of that will contribute to some good growth momentum. The third element is our hiring is not slowing down. We continue to hire. We added close to 3,000 people in this quarter. Our fresher projections for next year, we think we will hire a similar level of fresh talent to onboard into HCL Tech in the coming year. So these are all the leading indicators, and my pipeline continues to be pretty good. So you have to make your own assessment. I think all indicators are positive, and of course there is a macro, some discretionary spend will moderate, but there is a lot of counterbalancing factors like vendor consolidation, efficiency-led operating model changes, and cloud transformation, all of that. And these are all perfect sweet spots where we play in. And as I called out yesterday, Gartner is rated as, we are the only company in the leaders quadrant in all the 6 IT services magic quadrant of Gartner. So generally, we are in a very strong position to capitalize on the tech spend. That's really the outlook that I can provide at this point.
All right, that's the conversation with the HCL Tech management. But I have to say that the HCL Tech stock move does not inspire too much confidence, because, I mean, it opened at the low point, which is about 1,040 today. And then it rallied to 1,070, right? I mean, that's a big 30 rupee move straight out. and then it's corrected all the way. It's back at the day's lowest point. So not really inspiring in terms of confidence. The other one is LTTS, right? That's a big 6% cut now, 34.26 on LTTS, and we'll revisit that a little later. There is also a sort of a trend line technical break, which we will highlight, and that has happened just, the bulk of it today. But there's news flow, there, which the market doesn't like. Paytm is down 1.25%. These are some names which were not there in the mix earlier. L&T is starting. L&T has seen a few kind of positive notes from the sell side recently, but today it's starting about 1.6 lower, 2,124. Shriram Finance, of course, 2.5 lower. There was that block which we were talking about. Coforge is down 2.75%. L&T Mindtree, that is down 2% as well. So there's a lot of tech actually which is coming up with cuts. Motherson from the auto space is down 4% as well on decent sized volumes at this stage. Navin Fluorine is another one which saw a very large move yesterday. It was one of the largest volume-led movers, and that is starting down about 2% once again. So there's a fair bit of price action on the downside as well, which is led by volumes. We'll take a break here. We have the management of Galaxy Surfactants join us in just a bit to discuss their business outlook going forward. Later, we'll connect with Prabal Sen of ICICI Securities in terms of their expectation from the oil and gas sector ahead of the earnings. Stay tuned.